All right, folks, let us do our final lecture of the class and finish it and then just move forward. Is that whiskey? Are you like downing whiskey? Just can't handle it. It's the last class. Anyway, yeah, so this is this is it, folks. This is the last class. This is the last lecture, so let's get it over with. Anybody have any questions you want to ask me before I move forward? Yeah.
You said that your office hours aren't meant for like review, right?
Right, yeah, yeah.
So like, if we have a question, would you recommend not to ask you?
Yes. Well, it depends on the kind of question. Like, I would recommend asking on Piazza and then, having other people talk about it and maybe try to figure it out. Yeah, everything I teach you in class and I record it for you. So if you have an issue, like a question about something I covered, you can just go back to the recording and figure it out, right? So that's the whole point of that, yeah. Any other questions? All right. So just to keep in mind, though, I did post a practice exam online, and some people seem to be under the impression that the practice exam should be the exam, or the exam should be like close to the practice exam. Like that's the wrong idea, folks. The practice exam is an exam that I would give. An exam cannot have 4 weeks of information on it. Like it can't. So I'm not. Everything I'm covering in class is what you should be learning, and I've been telling you how you should be learning it. The terminology, the models. Like that's what's important, and that's what I test you on. And if you're plugged into the course, if you're listening to me, then you get a good idea of like what you should be focusing on. But then there's those people that are like, I don't give a crap about the lectures. I don't give a crap about the reading. Right before the exam, I'm just gonna memorize this practice exam, and somehow they feel like if that doesn't pay off, then they're kind of being cheated or something. I don't know. It's kind of silly. But the majority of you know, obviously, what you should be doing, which is learning everything we're covering in the way that I've asked you to learn it. And things will and are working out for you people that are listening to me. For those of you that are home, listen to me. You have to cover everything. Like, the practice exam is not the exam. Someone was like, the exam is different than the practice exam. Like, shocked. With a shocked demeanor. So, like, somehow I did a disservice to them and somehow tricked them into thinking that it would be, and then it wasn't. Like it's just, I don't know, folks. I deal with a lot. I deal with a lot as a professor. It's a fun job though. I recommend it. I do recommend it. It's fun. It doesn't pay a lot of money, but it's fun. It's like, think about it. Like you get to have the student schedule for the rest of your life. You get to have winters off and summers off, and like you don't have to work every single day, even though I am working every day, but I'm not working here every day. I'm at home. Like, yeah, I'm on the computer all day doing this and that and the other, preparing lectures, whatever. But I don't have to like be somewhere all day and like someone's like breathing down my neck and all that. So it's a nice lifestyle. It's worth it. Like if you can value those parts of the job versus like the money, which we'll come to. Obviously, believe me, I'll be fine. But but if you can really value like that aspect of the job, the lifestyle that comes with it, then it is like it's a very successful state, is what I'm saying, and it would be worth your time to pursue if you like kind of having a comfortable lifestyle. Anyway, let's talk about exchange rates and finish off the course. All right, so the behavior of the financial account. Again, the financial account is the account that accounts for financial transactions that occur between countries that create a liability. So the behavior of the financial account, reflecting the inflows and outflows of capital, we talked about what that is best described by equilibrium in the international loans market. The balance of payments on goods and services, though, so again, the balance of payments on goods and services, one of the components of the current account, the main component of the current account, is determined by decisions in the international markets for goods and services. So the exchange rate is what ensures that the two accounts offset each other, which is determined in the foreign exchange market. So again, the exchange rate is the price of one currency in terms of another. So let's delve into this exchange rate concept. In general, goods, services, and assets produced in a country have to be paid for in that country's currency, right? So if you're going to buy a bond from Europe, You need to pay for it with euros. If people are going to buy U.S. bonds in international bond markets, they got to pay for it with dollars. If they don't have dollars, they need to buy dollars first before they buy their asset. So the foreign exchange market is a market where currencies are traded in order for people to get the currency they need to buy the goods they want from the country they're buying from. The exchange rate is the price at which currencies are traded. So here we've got the US dollar, the yen, and the euros, and we have the exchange rates as of November 21st of 2014. So obviously 1 US dollar can exchange for 1 US dollar in international markets. 1 US dollar, though, is worth 117.76 yen. So the yen price of the dollar is this exchange rate. It tells us how much a dollar is worth in terms of yen, the Japanese currency. This tells us how much a dollar is worth in terms of euros. So the euro price of the dollar is 0.81 roughly. So that is the exchange rate between the dollar and the euros. In this case, we're measuring the dollar as so we're measuring the exchange rate as the euro price of the dollar. Now you can look at these exchange rates differently, depending on what perspective you're taking. So we could also look at the exchange rate for a yen. So what is the value of a yen in terms of US dollars? So how much is 1 yen worth in terms of US dollars? Well, it's worth 0.0085. And essentially to get from here to here, you just take the reciprocal. And the reciprocal will give you so if you're looking at the dollar price of the yen, that's this. And this is the yen price of the dollar. And they're just reciprocals of each other. So obviously 1 yen can be exchanged for 1 yen. And then this is the euro price of the yen. So how much a yen is worth in euros in this case is 0.0069. And then this row here tells us the euro exchange rate. So the dollar price of the euro. So 1 euro is worth $1.24. So if you are dealing with dollars and you want to buy a euro, you have to pay $1.24 for it essentially. And again, it's the reciprocal of this. So the dollar price of the euro is the reciprocal of the euro price of the dollar. And then the yen tells us the yen price of the euro. So 1 euro is worth 145.88 yen, the reciprocal of this. The euro price of the dollar, the yen price of the euro. I'm sorry, the euro price of the yen price of the euro, and of course, a euro can be exchanged for 1 euro. So there's no fixed rule for writing the exchange rate. So there's no like standard way of saying, well, if you're in this country, it's always going to be like, the foreign currency price of your currency and vice versa. So most countries do express the exchange rate as the price of a dollar in their domestic currency. So this is relatively standard, but not necessarily. And again, it's the domestic currency value of $1. So again, it would be these over here on this row, which tells us the dollar price of the dollar, the yen price of the dollar, and the euro price of the dollar. Sometimes the exchange rate is expressed in the opposite way. It's expressed as the dollar value of their domestic currency. So that's what we get over here. So again, 1 euro is worth 1 yen is worth 0.00085 euros. I'm sorry, dollars. 1 euro is exchanged for, so the dollar price of the euro would be this, so 1.24. Now, the important thing to know is just what you're talking about, just like to be consistent with what form you're using. That's it. Like there's no standard way. You just have to, whatever context you're discussing exchange rates in, you have to just identify what form is it taking, and then just continue using that form within that context so that there's no confusion about what you're talking about. So when discussing movements in exchange rates, obviously the movement up or down, economists use specialized terms to avoid confusion. So you have currency appreciation, which again, which is a very specific term, which talks about the increasing value of one currency in terms of other currency. So if the dollar is becoming, the dollar is becoming stronger now based on what we've learned from the Economist article. That means the dollar is appreciating in international value. The exchange rate is increasing because the dollar is appreciating. the exchange rate measured as the again the foreign currency price of the dollar. Yeah.
Considering that we were what the dollar was more valuable than the euro at one time, is that because the dollar is getting stronger, so that we might get to the same point again?
It's possible, yeah. Like they're kind of projecting that the euro is falling and the dollar's going up, so it could eventually even out again. But who knows? You know, you only know what's happening right now and what could happen, but that hasn't happened yet. But it could. It'd be nice, right? We can go to Europe and just kind of save you a lot of money, right? You can have like a decent vacation. Um, anyway, so if the value of a currency is going down, then we say the currency is depreciating. So movements in exchange rates, other things equal, affect the relative prices of goods, services, and assets in different countries, right? So like I mentioned at the beginning of the lecture, if the dollar is getting stronger, that means that our goods are becoming more expensive to people overseas, and overseas stuff is becoming cheaper to us. So let's talk about how we get to an exchange rate via our standard supply and demand model. So assume there's only two currencies in the world, the US dollar and the euros. So here we're looking at an exchange rate, and we're measuring the euros per US dollar, so the euro price of dollars. So how much a dollar can be changed for in terms of euros. So we're going to obviously set up an equilibrium exchange rate here, the exchange rate at which the quantity of a currency demanded in the foreign exchange market is equal to the quantity supplied. So you got a downward sloping demand for US dollars, a demand of currency from foreigners who want to buy domestic goods, services, and assets. And then you've got a supply. The supply of US dollars is a supply of a currency from domestic residents who want to buy foreign goods, services, and assets. And so they will equilibrate at some exchange rate. In this case, the exchange rate is 0.74, and again, it represents the euro price of the dollar. So that means that a dollar can be exchanged for 74 euro cents, essentially. To understand the equilibrium exchange rate, consider a hypothetical example. So you've got European purchases of US dollars in trillions of dollars in this row, and then you've got US sales of US dollars in trillions of dollars in this row. So to buy US goods and services, Europeans need, let's say, $1 trillion, right? So they're demanding $1 trillion US dollars to buy our goods and services. They also need $1 trillion US dollars to buy our assets. So therefore, the total purchases of US dollars will be 2 trillion. To buy European goods and services, we need, let's say, 1.5 trillion euros. And so we're going to sell 1.5, I'm sorry, not 1.5 euros. We're going to sell 1.5 trillion US dollars in order to buy European goods and services. To buy European assets, we need to sell $500 billion. And so our total purchases, our total sales of US dollars then equal 2.0 as well. At the equilibrium exchange rate, the total quantity of US dollars that Europeans want to buy is equal to the total quantity of US dollars that Americans want to sell. So this column here basically tells us, the transactions that we engage in under the balance of payments of the current account in which we're buying goods and services, and Europeans are buying goods and services from us. And so the U.S. balance of payments on the current account is going to be negative 0.05. So there's going to be a trade deficit because we are buying less. We are buying more goods than Europeans are buying from us. So we're buying $500 billion more in goods than they're buying from us. So there is a trade deficit. So the U.S. balance of payment on the current account is negative 0.5. So if this is the current account, then what is this? It's the financial account, right? Exactly. It's the other account that has to do with transactions that create liabilities, right? And so this is the balance of payments on the financial account. And in this case, Europeans are buying $1 trillion in our assets. We are selling $500 billion to buy $500 billion in their assets, and therefore we are going to have a surplus of we're going to have a positive balance of payments on the financial account. And then those two are going to equal out. So at the equilibrium exchange rate, the sum of the balance of payments on the current account plus the balance of payments on the financial account is equal to 0, just based on this very simple example. So consider what happens when there's a shift in the demand for US dollars. And how that affects equilibrium in the foreign exchange market. So there's an increase in the demand for US dollars. So people want to buy more of our goods and services. People want to employ more of our factors of production. They want to buy more of our assets. So let's say there was a contractionary monetary policy, open market operation, which then shifted the so here is the demand for money, here's the supply for money. It shifted the supply for money that raised the interest rates in the United States, right? Raising interest rates in the United States is going to draw investors from overseas. In order for them to invest in our country, they are going to need our dollars. So let's say that is what caused the demand for our dollars to increase and therefore shift to the right in the foreign exchange market for our dollars. So suppose that for some reason capital flows from Europe to the United States increase, say due to the change in preferences of European investors. That's another reason that could happen. So an increase in the demand. So that's going to obviously raise the euro price of a dollar, right? The exchange rate of the dollar is going to go up. The dollar is going to be stronger as it is right now based on what we covered in the Economist article. So this, again, leads to an appreciation in the US dollar. So what are the consequences of this increased capital inflow for the balance of payments? So let's track how that affects our balance of payments. So European purchases of US dollars, is that going to go down or is that going to go up? It's going to go up, right? They're demanding more of our dollars, right? So to buy US goods and services, it's actually going to go down by, oh, okay, that's right. We're talking about goods and services. So our goods and services, because our dollar has gone up, I forgot that we were looking at the goods and services column. Our goods and services, because our dollar has appreciated, are more expensive, right? So people are going to buy less of our goods and services, right? So that has gone down by 0.25. To buy U.S. assets, and that's what they're going to want to do. They're going to want to buy U.S. assets. That is going to go up by, in this case, $500 billion. So they're going to buy $500 billion more dollars, more U.S. dollars, and sell euros in order to buy those. How is that going to affect us? Okay, so as far as U.S. sales of U.S. dollars to buy foreign goods and services, is that going to go up or down? So our dollar is worth more, right? So that means that stuff overseas is going to be cheaper, right? So it's going to go up, right? Right. Well, as far as over here goes, as far as like the total purchases of US dollars from Europeans, it's 2.25. But to buy European goods and services, yes, because now European goods and services are relatively cheaper because our dollar is stronger, then obviously we are going to sell more dollars to buy goods and services from overseas because now they're cheaper. So that's going to go up by 0.25. To buy European assets, let's assume there's no change there, so that's going to be 0.5. And so that's going to equal then 2.25 total sales of US dollars. So any change in the US balance of payments on the financial account, which is what happened, which is what spurred this change, generates an equal and opposite reaction in the balance of payments on the current account, which is what we witnessed. So therefore, the US balance of payments on the current account is going to be, in this case, still in a deficit, but it's going to be down by 0.5. And the US balance of payments on the financial account is going to go up by 0.5, and they are still going to equal 0. So it's all going to balance out. So again, the changes over here are going to offset the changes over here, and then they're going to equal out. And it's the exchange rate which causes that to happen, and therefore the balance of payments to ultimately be equal to 0. Yeah.
This is hypothetical. right?
Yeah.
That's the actual.
Yeah, this is just a hypothetical example to explain how it could work, how it does work, but how it could work in this example. All right, let's talk about how inflation affects interest rates. And remember, there's going to be inflation, changes in the price level in both countries that are transacting. So to take account of the effects of differences in inflation rates, economists calculate real exchange rates. The real exchange rate is an exchange rate adjusted for international differences in aggregate price levels. So suppose that the exchange rate we're looking at is the number of Mexican pesos per US dollar. So it's the peso price of the dollar. That's the exchange rate we're looking at. So how many pesos you need to buy a dollar and how many pesos you can get for a dollar. So let's let PUS equal the price level in the US and PMEX be the price level in Mexico. They're indexes of the aggregate price level in the US and Mexico respectively. So they could be like the CPI of both countries, the consumer price indexes. They can also be the GDP deflator, whatever index we're using. So the real exchange rate between the Mexican peso and the US dollar is, so again, we're looking at the real exchange rate, which is going to equal Mexican pesos per US dollar times the US price index over the Mexican price index. So in this case, we're looking at the Mexican peso price of the US dollar. So we have the Mexican peso on the numerator and the dollar in the denominator. So remember, whenever you're looking at the real value of something, you usually take its value and you divide it by the price level to get to the real value. So the real value of the Mexican peso is going to be the Mexican peso divided by its price level, right? Its price index. The real value of the US dollar is going to be its dollar divided by its price index, but the dollar is in the denominator here, so therefore the price level will be on the numerator, right? So that's just a way to remember it, a way to remember how the real exchange rate is set up. So you gotta be very careful about how the exchange rate is being measured, and then you'll be able to figure out, well, then how does the real exchange rate look? So to distinguish it from the real exchange rates, the normal exchange rate we've been talking about, unadjusted for the aggregate price level, is sometimes called the nominal exchange rate. To understand the significance of the difference between the real and nominal exchange rates, consider the following example. Suppose the Mexican peso depreciates against the US dollar by 50%. So that means that the US dollar has appreciated by 50%, right? Or that the Mexican peso has depreciated by 50%, depending on how you look at it. Suppose that at the same time, the price of everything in Mexico increases by 50%. So the price level in their country goes up by 50%, right? Everything has gone up in price by 50%. So the Mexican price index then rises from 100 to 150. Suppose that there's no change in US prices. So you've got the pesos per dollar before the depreciation. So you've got the old exchange rate times the US price level over the Mexican price level, which gives us the real exchange rate. Let's say the peso per dollar, so this is the peso price per dollar, is 10. And the price levels are going to each equal 100 because at the starting point, nothing has changed. The prices are what they are. We consider that to be the first base year for the price levels in each country. So it's going to be 10 times 100 over 100, which is equal to 10. So that's going to be the real exchange rate before the changes in both the exchange rate, which is a depreciation of the Mexican peso, and the increase in the price level in Mexico. Let's look at what happens to the real exchange rate after the depreciation. Well, the dollar price, the peso price of the dollar is going to go up because the Mexican peso has depreciated, and so that means the dollar has appreciated, right? So because Mexico has depreciated against the dollar by 50%, that means that the dollar has appreciated by 50%, so it goes up to 15 Mexican pesos. Times the US price level remains at 100, but the Mexican price level has gone up to 150 now because all prices have gone up by 50%. And therefore, if we multiply this, the 15 cancels out here, so you're left with essentially 1 over 10 there, so that's 100 divided by 10, which gives us 10. And therefore, the real exchange rate has not changed. The real exchange rate has remained the same. So the price levels in the country are obviously also going to be of importance to like these international flows of goods and services and assets. Since the real peso to US dollar exchange rate hasn't changed, the nominal depreciation of the peso against the US dollar will have no effect either on the quantity of goods and services exported by Mexico to the United States, nor the quantity of goods and services imported by Mexico from the US. So as far as their international transaction goes, everything's the same because, again, of both of these movements, both in the nominal exchange rate and in the price level of Mexico. So a country's products become cheaper to foreigners only when that country's currency depreciates in real terms, and those products become more expensive to foreigners only when the currency appreciates in real terms. So here is the peso per US dollar. So here's the exchange rate of which again is represented as the peso price of the dollar from 1993 to 2003. Here's the real exchange rate. It's remained fairly stable, in fact, pretty much constant the entire time. But the nominal exchange rate has gone up, and that's because exactly reflecting the conditions of what we just talked about. The price level in Mexico has actually been going up during that time period. The price level in the US has remained pretty stable, and therefore the real exchange rate has remained the same. All right, now let's talk about this other exchange rate, which is called the purchasing power parity. A useful tool for analyzing exchange rates closely connected to the concept of the real exchange rate is known as the purchasing power parity, the PPP. The PPP, the purchasing power parity, between two countries' currencies is the nominal exchange rate at which a given basket of goods and services would cost the same amount in each country. So it's the, again, it's the exchange rate at which the goods would exactly equal each other in value in both countries. So let's say a basket of goods and services that costs $100 in the US costs 1,000 pesos in Mexico, then the PPP would be 10 pesos per US dollars. At that exchange rate, 1,000 pesos equals $100, so the market basket costs the same amount in both countries. Nominal exchange rates almost always differ from the purchasing power parity, though. And this is what's called a puzzle in economics. It's one of the macroeconomic puzzles. It's one of the ones that macroeconomists are always kind of trying to figure out, because ideally what should happen is that exchange rates should always be at the purchasing power parity. There should never be a difference between the price of a thing in one country versus the price of a thing in another country. They should be exactly equal in terms of the real value, but they actually wind up not being the case. So in general, aggregate price levels are lower in poor countries than in rich countries because services tend to be cheaper in poor countries. Even among countries at roughly the same level of economic development, nominal exchange rates vary quite a lot from the purchasing power parity. So this is the Canadian dollar price of the US dollar. That's the exchange rate we're looking at. Here's the purchasing power parity. It's about roughly 1.25, let's say. And here's the nominal exchange rate. It is fluctuating around it. So the PPP between the US and Canada didn't change much over that period because the countries had roughly the same amount of inflation. So the purchasing power parity stayed roughly the same. But when the nominal exchange rate is below the PPP, so in this case, the Canadian price of the dollar, so when the nominal exchange rate is below the PPP, that means that the dollar is valued less in terms of Canadian dollars than it should be, then the basket of goods that's being considered, that's being compared across both countries, is going to be more expensive in Canada. And when the nominal exchange rate is above the purchasing power parity, that means the basket of goods is going to be more expensive in the US. So it's kind of like this weird way. You just kind of have to really get in there and like really take the perspective that you need to in order to truly see that. Over the long run, however, purchasing power parities are pretty good at predicting actual changes in nominal exchange rates. Nominal exchange rates between countries at similar levels of economic development tend to fluctuate around levels that lead to similar costs for a given market basket. So even though they don't converge to the purchasing power parity, they tend to just kind of fluctuate around it. Once a year, The Economist publishes a list of purchasing power parities based on the cost of one good, of one basket of goods, which is just the Big Mac. So buying a market basket that contains only the McDonald's Big Mac. The Big Mac Index looks at the price of a Big Mac in local currency and computes the following. The price of the Big Mac in US dollars using the prevailing exchange rate. The exchange rate at which the price of a Big Mac would equal the US price. If the purchasing power parity held, the dollar price of a Big Mac would be the same everywhere. So here is this information from July of 2014. India, China, Mexico, Britain, US, Japan, Euro area, Brazil, Switzerland. Here's the Big Mac price in their local currency, and here it is in US dollars based on their actual exchange rate. So we see that in US dollars, the prices are different. So in reality, we would assume that all prices would converge to the same price internationally, but obviously that is not the case. You see that in India, the Big Mac in US dollars is less than that in Japan. In Mexico, it's almost twice that. Britain, almost 3 times that. US, the actual price, obviously we developed it. So India is priced less than us. Japan, a little bit less than us. Euro area, roughly the same. Brazil, even more expensive than us. Switzerland, definitely more expensive than us. India uses the rupee. China, the yuan. Mexico, the peso. Britain, the pound. Japan uses the yen. Euro area, the euro. Brazil, the real. And Switzerland, the Swiss franc is their currency. The implied purchasing power parity, the exchange rate that it should be to equal out the prices of the Big Macs is here. And this is the actual exchange rate. So this is the local currency per US dollar. So we see that the actual exchange rate is above the implied PPP. That means that prices are lower than they should be in India. In China, the actual exchange rate is above the implied PPP. So again, prices are too low in China. Mexico, again, above, same thing. Britain, roughly the same. So things are pretty much fine there. Obviously, we're the same. Japan, again, prices are too low there. European area, roughly what it should be. Brazil, the prices are a little bit high because the actual exchange rate is below the implied PPP. And in Switzerland, again, prices are, in this case, a little bit high in Switzerland. So again, that is the information we're getting from the purchasing power parity. And that's sort of what information that it can tell us. It can tell us, like, are prices within the countries actually behaving the way that you would expect them to behave given what's happening internationally, where you can see that it doesn't always work out the way. And that's, again, why this is one of those macro puzzles where a lot of macroeconomists are currently always trying to solve it. Like, what exactly is causing prices to not be equal across all countries for the same goods in terms of real value? And, it has a lot to do with internal conditions and just frictions that don't allow markets to equilibrate the way they naturally would. So there's market failures, there's things that are getting in the way of that happening, and that's what people are trying to figure out all the time. All right, let's talk about exchange rate policy. So again, you can see that the exchange rate has a big impact on the demand for goods and services, the demand for assets in a particular country, and that's going to affect economic activity and the economic outcome of a country. And therefore, countries want to kind of control their exchange rate, because obviously if they leave it out of their control, it can be a problem sometimes, but also it can be a good thing. So we'll talk about both sides of that argument. So let's talk about the exchange rate regimes, the approach that a government might take to managing their exchange rate. So exchange rate regime is a rule governing policy toward the exchange rate by a government. They can either have a fixed exchange rate, where the government keeps the exchange rate against some other currency at a nearly particular target. And then they could have a floating exchange rate. And the floating exchange rate involves the government just letting market forces determine the exchange rate. So just kind of letting the international demand and supply for their currency do what it's going to do, and then just deal with the consequences of that. At times, governments will enact policies in between, where they'll jump between either an exchange rate or a floating exchange rate. But here we're going to focus on the two extreme cases. So how can an exchange rate be held fixed is the question. So consider a hypothetical country, Genosha, which has decided to fix the value of its currency, the Geno, at US 150. So this exchange rate is the US price of the Geno. The problem may be that the target may not be the equilibrium exchange rate. So the target that the country is setting for themselves, because they either want it high or low, because they want their goods to be really cheap or really expensive to the rest of the world, is not where the actual supply and demand for their currency is equilibrating. So if Genosha wants to fix its exchange rate above its equilibrium value, it's going to have to buy its currency, and therefore it's going to have to sell dollars in order to buy its currency. So here's the demand for the Geno, which is that country's currency. Here's the supply of it. Here is the equilibrium exchange rate. And let's say the target is 150, which is above their equilibrium. So in order to get to that target, right now they feel that their exchange rate is too low, therefore their currency is weak. Their goods are cheap, but goods from abroad are expensive for them. So obviously that's obviously something they don't want. They want their currency to be stronger. And so in order for them to get their currency up to that price, they could, one, buy a bunch of their currency. But in order to buy another country's currency, you need to have like foreign currency to sell for your currency. So if Genosha wants to fix its exchange rate, so that's one case. So the other case is if Genosha wants to fix its exchange rate below its equilibrium. So here's the equilibrium, and let's say they want the price of their currency to be lower because they want their goods to be cheaper, like China. So this is what China essentially does. China keeps the value of their currency artificially low. So this is the scenario that basically covers the logic behind how they get that done. So the international, the foreign exchange markets, the forex, for let's say the yuan, the Chinese currency, wants to set the value above what the Chinese government wants to set it at, which is below the equilibrium. So if a country wants to fix its exchange rate below an equilibrium, it's going to have to sell its currency and buy some international currency instead. The dollar is usually the best bet. So what they do in order to make that happen is if they sell their currency, then essentially they are going to increase the supply. They're going to shift the supply curve to the right, and they will get the equilibrium to the point they want it to. They're going to get it to that lower exchange rate, which is what they do, which is what China does. Whenever a government tries to fix their exchange rate and have a fixed exchange rate regime, and therefore buy or sell their own currency, they engage in what's called exchange market interventions. A government purchases or sells purchase or sale of currency in the forex, foreign exchange market. So again, we're talking about this hypothetical country, Genosha, its currency Geno. To buy Genos in the foreign exchange market, the Genosian government must have US dollars to exchange for Genos. So if any government is going to engage in this kind of foreign exchange intervention, exchange market intervention, they have to have reserves of other currencies on hand. And so that's another reason why the Chinese government had a bunch of our bonds, because they knew that if they needed to, they could sell the bonds for dollars and then use the dollars for the foreign exchange market interventions in order to keep their currency artificially low. A second way for the Genosian government to support the Geno is to shift the supply and demand curves for the Gino in foreign exchange markets. So governments usually do this by changing their monetary policy. So another thing they could do is not engage in the foreign exchange market intervention by buying and selling currency themselves. They could affect other countries' demand for their country's currency by maybe lowering the interest rate or increasing the interest rate, right? Depending on what they want to accomplish. If they lower the interest rate, then folks are going to want to leave their currency and go to countries that offer higher returns on assets. And if they raise the interest rates, then vice versa. The opposite will happen. They'll attract investors, which means that the demand for their currency will increase, which will appreciate their currency. So an increase in a country's interest rate will increase the value of its currency. And again, that's another way that they could hit their fixed exchange rate regime target. A third way the Genosian government can support the Gino is by reducing the supply of Ginos to the foreign exchange market. So another thing they could do is stop their domestic residents from buying foreign currency. So they can do this by requiring domestic residents who want to buy foreign currency to have to get a license, and then giving these licenses only to people engaging in approved transactions. So really limiting the amount of transactions that their domestic residents are able to engage in the foreign exchange markets. Argentina has been doing this for a very long time recently. They've been stopping their residents from being able to buy dollars because, again, like they wanted to strengthen their currency. So this is what's called foreign exchange controls when they take this approach. They have foreign exchange controls, licensing systems that limit the rights of their own country's individuals to buy their foreign currency. Other things equal, foreign exchange controls increase the value of a country's currency. All right, so let's talk about Gesundheit, the differences between these regimes and sort of like the pros and cons of them. So the question of the exchange rate regime is a contentious one in macroeconomics. The case for a fixed regime is as follows. So if you fix your exchange rate, then you're going to have a stable exchange rate, which reduces uncertainty for businesses. So uncertainty has the effect of deterring trade between two countries, right? So if the price of the currency is going up and down, then that's scary for international investors or buyers of goods and services. Like they don't necessarily know what they're going to face tomorrow, the next day. The value of their investment could dramatically fall if they invested in that country's currency. And so it tends to detract investors if a country is really unstable, and a fixed exchange rate regime will give international investors a little bit more confidence. Also, by committing themselves to a fixed rate, a country is also committing itself not to engage in inflationary policies. So in order to fix their exchange rates, they're going to use their monetary policy, which means that so they're not going to be using their own policies for their own economic policy initiatives, such as fiscal monetary policy. They're going to be focusing more on having the price of their currency in international markets be at the equilibrium they want it to be at, and so that's going to detract their power to again raise prices within their own country, which is a good thing because then the government won't create that potential for that hyperinflation, which can totally devalue the currency. So that also creates some confidence in investors. The case against the fixed regime, so exchange market interventions require large reserves. So countries need to have large reserves of foreign currency, so they need to have huge foreign exchange reserves. If a country chooses to stabilize an exchange rate by adjusting monetary policy rather than through intervention, it has to divert monetary policy from other goals. Foreign exchange controls like import quota, so limiting people's ability to sell their own country's currency and buy foreign currency, has the same effect as import quotas and tariffs, which distort incentives for importing and exporting goods and services. So goods and services markets don't get to equilibrate the way they normally would. So different countries reach different conclusions at different times about whether they should have a floating exchange rate regime or a fixed exchange rate regime. It's an extremely complicated question because you're talking about both the internal economic conditions that affect the economy and should be managed, and also the international economic conditions which affect their economy and should be managed. And so it's like these two opposing sort of uh, goals that it's a hard balancing act ultimately. Like you don't really know what to focus on, so you just wind up focusing on one thing versus another at different times, depending on the signs that things may or may not be happening in the future, based on economic analysis that projects prices of, this, that, or the other. So that's why economic analysis becomes really important, because you want to be able to project as much as possible what may happen in order to think, okay, so then should I be focusing on my exchange rate versus like my internal, monetary and fiscal policy goals? So as far as like the European area, so they had like before they had the euro, they basically established a pact. It was called at the Bretton Woods Conference in 1944. You had representative of the Allied nations that essentially won the war. In New Hampshire, came together and established a post-war international monetary system of fixed exchange rates amongst the major currencies. So the big winners from after World War II kind of got together and said, well, let's just fix all of our exchange rates in order for us to then be able to have like this collective stability within our economies, and therefore, have those like strong connections and interactions that would boost economic activity throughout the entire the group. So it worked well until 1971, but by 73, most countries let their currencies float. So this is the franc per mark. So the franc is the old currency that France used to use. The mark is the old currency that Germany used to use. So this is the franc price of the mark. And you can see that post 1971, that started to fluctuate up until around the 90s where it stabilized. So Europe wanted to return to exchange rate stability. So it fixed the exchange rates with minor fluctuations allowed, culminating in the adoption of the new euro currency in the late 90s, early 2000s. So around this time, they realized, well, in order to be able to get to that one currency union that they now have, they needed to, have a period of time where they basically fixed all exchange rates, and so that's what this represents. It represents that time period. All right, let's look at the final section of the course: exchange rates and monetary and macroeconomic policy. So, what are the issues raised by open economy macroeconomics? So one is what's called the devaluation and revaluation of fixed exchange rates. So when we're talking about the movement of an exchange rate under a fixed exchange rate regime, where let's say they decide, okay, we fixed it at this amount, now we want to raise it to another fixed amount, or we want to lower it to another fixed amount, then that's going to be called a devaluation if it's going down, or a revaluation if it's going up. And that's in contrast to an appreciation or depreciation of the exchange rate that happens under a floating exchange rate regime. So you have to be very sort of tuned into the terminology here to really know what you're talking about. So historically, fixed exchange rates haven't been permanent commitments. A devaluation is a reduction in the value of a currency that is set under a fixed exchange rate regime. A revaluation is an increase in the value of a currency that is set under a fixed exchange rate regime. Devaluations and revaluations serve two purposes under fixed exchange rates. First, they can be used to eliminate shortages or surpluses in the foreign exchange market. So let's say, again, they are at some target that is either above the equilibrium, in which case there will be an excess supply of the currency at that price, or below, in which there will be a shortage. So under those circumstances, they might do either a revaluation or devaluation to get the exchange rate to the equilibrium level in order to get rid of that market distortion. Second, a devaluation and revaluation can be used as tools of macroeconomic policy. So again, you have a target for the exchange rate, and let's say you want to expand the amount of aggregate demand in your country, but you want it to happen by international buyers of goods and services. So in order to do that, you're going to have to raise your interest rate, right? You're going to have to raise your interest rate, which will then cause the demand for your currency to increase, which will then raise the value of your currency. So then that will essentially be a macroeconomic revaluation of your exchange rate. So the whole purpose of that is to get your exchange rate up to a higher value in order to increase the amount of aggregate demand in your economy in order to increase the equilibrium GDP. The opposite case is a devaluation by increasing exports and reducing imports. By devaluating, again, you're lowering the value of your currency, so your goods are cheaper to the rest of the world, so you'll increase exports. And again, foreign goods are going to be more expensive when you devalue because your currency is going to be worth less, so you're going to buy less imports. And that's going to increase aggregate demand because, again, under those circumstances, people are going to want to buy more of your goods. So monetary policy under floating exchange rates, the other case. So under a floating exchange rate, there is no target. There's a demand and a supply for a country's currency, and it equilibrates at some price. So under floating exchange rates, expansionary monetary policy causes the currency to depreciate and helps increase aggregate demand even more. So again, expansionary monetary policy means that the interest rate is going down because the money supply has increased. When the interest rate has gone down, then folks are less interested in investing in your country because your interest rate is lower. The return on their investments are lower, and so that causes the demand for your currency to go down, which lowers the exchange rate, which then lowers the price of your goods, which then increases the demands for your goods internationally, which then increases aggregate demand. So you got to think about all those links and how it all works. So again, under a floating exchange rate, expansionary monetary policy causes the currency to depreciate and helps increase aggregate demand more. Contractionary monetary policy has a reverse effect. So contractionary monetary policy raises interest rates. It causes people to want to invest in our country, which means demand for our currency goes up, which means that the exchange rate goes up, which means that our goods are more expensive, so people buy less of our goods. So that lowers aggregate demand, which lowers equilibrium, the equilibrium GDP within the country. So in this case, after their interest rate falls, Genosians invest more abroad, buying more US dollars and selling more Genos. In this case, the supply of the Genos increases and foreigners invest less in Genosha, reducing their demand for Genos. So that then lowers the demand, which then has a net effect of lowering the exchange rate to this level here. It leads to a depreciation of the Geno. And then finally, international business cycles. The fact that one country's imports are another country's exports creates a link between the business cycles in different countries. Within their own countries, again, the business cycle is the amount that their GDP is fluctuating around their long-run equilibrium GDP, right? Which is their potential GDP. So floating exchange rates may weaken that link, and that's a potential problem. Anyway, we're done with the material for the class, folks. Congratulations. Now let's go through 4 practice problems, and we'll call it a class. All right. So first question here, balance of payments question. Which of the balance of payments accounts do the following events affect? Boeing, a U.S. U.S.-based company, sells a newly built airplane to China. So which of the balance of payments accounts does that affect? It's a sale of goods and services, right? So what does that fall under? The balance of payments on the, what was that? What is that called in terms of like our balance of payments sheet? The current account. Exactly, it is the current account. So the sale of the new airplane to China represents an export of a good to China and so enters the current account, right? Versus the what? Financial account. Exactly. In which transactions fall that create what? Liabilities, etc. Exactly, etc. Chinese investors buy stock in Boeing from Americans. So Chinese investors buy stock from Boeing, from Americans in Boeing. Financial account, right? A stock is a liability because it is a claim on a profit stream, right? So the sale of Boeing stock to Chinese investors is a sale of a U.S. asset, so it enters the financial account. A Chinese company buys a used airplane from American Airlines and ships it to China. So think about what's being bought and where it's going. So what is it? It's a current account, right? Right, exactly. So even though the plane already exists when it's shipped to China, it's an export of a good from the United States. So the sale of the plane enters the current account. A Chinese investor who owns property in the U.S. buys a corporate jet, which he will keep in the U.S. so he can travel around America. It's purchased in the U.S. and it's left in the U.S. So current account has to do with international transactions, right? So it is a financial account, and it's just a weird way of thinking about it. But because they are buying this jet and leaving it in the U.S., essentially it is a liability for them because eventually they will need to get out of that jet that is being used within the U.S. Right? So because the plane stays in the U.S., the Chinese investor is buying a U.S. asset. So this is identical to the answer to part B. The sale of the jet enters the financial account. All right. All right. Let's go to 19.2, exchange rate effects. Mexico discovers huge reserves of oil and starts exporting oil to the U.S. Describe how this would affect the following. The nominal peso to U.S. dollar exchange rate. So this is the value of the U.S. dollar in pesos. Again, Mexico discovers huge reserves of oil and starts exporting to the U.S. So we are buying oil from Mexico. To buy oil from Mexico, what do we need? We need pesos, right? So what happens when the demand for something increases? Right? So what happens to the price? It increases, right? So what is that called in terms of our language of talking about exchange rates? The exchange rate appreciates, exactly. Okay, so let's look at that one. We don't need to go through this. So here's our foreign exchange market, peso per dollar. And there's a quantity of US dollars, downward sloping demand, upward sloping supply. There's our equilibrium price and quantity. So the nominal peso to US dollar exchange rate. So again, the increased purchase of Mexican oil will cause US individuals and firms to increase their demand for the peso. To purchase pesos, individuals will increase their supply of US dollars to the foreign exchange market, causing a rightward shift in the supply of US dollars. So this is the amount of US dollars in pesos. So what's going to happen here is that the supply of US dollars will increase, which means that the dollar is going to depreciate relative to the Mexican peso, but the Mexican peso is going to appreciate, right? And you're going to have that increase in demand for the peso in the foreign exchange market for pesos. So this will cause the peso price of the dollar to fall. The amount of pesos per dollar will fall. So the peso US dollar exchange rate will go down because, again, we're talking about the value of the US dollar in terms of pesos, right? So the peso is appreciating and the US dollar is what? Exactly. All right. The peso has appreciated and the US dollar has depreciated as a result. Mexican exports of other goods and services. So how is that going to affect Mexican exports of other goods and services? Are they getting less for exporting their goods? The peso's appreciated. So think about what's happening to the price of their goods in international markets. The price of their goods, but then the demand's going to decrease. That's what you meant, right? Right, exactly. The goods are now more expensive. Other goods and services are now more expensive to everybody because the peso is worth more. That means to buy Mexican goods, you need to buy pesos, which cost more in terms of other currencies, right? So people are going to buy less of their other goods and services, right? So the appreciation of the peso means it will take more US dollars to obtain the same quantity of Mexican pesos. If we assume the price level measured in Mexican pesos of other Mexican goods and services does not change, then other Mexican goods and services become more expensive to U.S. households and firms. The dollar cost of other Mexican goods and services will rise as the peso appreciates. So Mexican export of goods and services other than oil will fall. What about Mexican import of other goods and services? Increase, right? Exactly. It's going to increase, right? Their currency is worth more now in terms of international dollars, right? In terms of the real value of their currency, it's higher. They can buy more with their peso now because the price has gone up. And so U.S. goods and services become cheaper in terms of peso. So Mexican imports of goods and services will rise. All right, that's that question. Let's go to 19.3, the real exchange rate and the purchasing power parity. A basket of goods and services that costs $100 in the U.S. costs 800 pesos in Mexico, and the current nominal exchange rate is 10 pesos per U.S. dollar. Over the next 5 years, the cost of the market basket rises to $120 in the U.S. and to $1,200 pesos in Mexico, although the international nominal exchange rate remains at 10 pesos per U.S. dollar. Calculate the following. The real exchange rate now and 5 years from now if today's price index in both countries is 100. All right, so the real exchange rate. So we're talking about the nominal exchange rate is 10 pesos per US dollar. So we're talking about the peso price of the dollar. So if we're talking about the peso price of the dollar, then how do we calculate the real exchange rate? The nominal exchange rate times what? PUS, like again, the price index of the US over the price index of Mexico, right? All right, so let E equal the nominal exchange rate, pesos, dollars. PUS equal the aggregate price level in the US. PM equal the aggregate price level in Mexico. Multiplying E by PUS gives us the price of US goods in pesos. Dividing the price of US goods in pesos by the price level in Mexico gives us the price of US goods adjusted for the price level in Mexico, which is the real exchange rate. So again, we have the pesos per US dollar times the aggregate price level in the US over the aggregate price level in Mexico. So this is our real exchange rate. The peso price of the dollar times the price index in the US over the price index in Mexico. So we're calculating the real exchange rate now in 5 years from now if today's price index in both countries is equal to 100. So we know today that the nominal exchange rate is 10, right? So E is 10. We know the price level in both countries are equal to 100. So today the real exchange rate is equal to 10 times 100 over 100, which is equal to 10, right? So today's real exchange rate is 10. The aggregate price level in 5 years in the U.S. will be, so remember, in the next 5 years, the cost of the market basket rises to $120 in the U.S. So the aggregate price level in the U.S. in 5 years, so T plus 5 essentially just means in 5 years, is going to then equal 120, right? It's going to, the price index represents a 20% increase in prices. Prices were 100, now they're 120, right? They've gone up by 20%. So that's our price index in the U.S. Over 100 times 100 equals 120. The aggregate price level in 5 years in Mexico. So in Mexico, the goods in Mexico were initially, I think, 1,000. Wait, no, like 800 pesos in Mexico, and now they're 1,200 pesos in Mexico. So that means that the prices have gone up by what percentage? 400 is what? 400 is what percent of 800? 50%, right? 50%. So the price level in Mexico, 1200 over 800 times 100 is going to equal to 150. So the real exchange rate in 5 years is therefore going to equal 10 times the U.S. price level over the U.S. price index over the Mexican price index, which is equal to 8. So that is what the real exchange rate is. It is 8. So the real exchange rate 5 years from now will be 8. So we're going to calculate now purchasing power parity today and 5 years from now. So again, purchasing power parity between two countries' currency is the nominal exchange rate at which a given basket of goods and services would cost the same amount in each country. So today, a basket of goods and services that costs $100 costs 800 pesos. So to figure out the purchasing power parity, we have to multiply 800 times that purchasing power parity to get to 800. So if we divide both sides by 100 here, that gives us a purchasing power parity today to be 8. So 8 pesos per US dollar is the purchasing power parity. Again, the exchange rate that would make all goods exactly equal in real terms across countries. So the purchasing power parity is 8 pesos per US dollar. In 5 years, a basket that costs $120 will cost 1,200 pesos. So we're going to have 120 times the purchasing power parity in 5 years is going to equal 1,200. And so if we divide both sides by 120 there, we get a purchasing power parity of 10. So that's how you calculate the real exchange rate and the purchasing power parity. So the purchasing power parity will be 10 pesos per US dollar in 5 years. And finally, exchange rate and trade effects, 19.4. Suppose the US and Japan are the only two trading countries in the world. What's going to happen to the value of the US dollar if the following occurs? Other things equal. So we assume everything else is not changing, only what's happening in the problem, in the prompt. So again, we're wondering what's going to happen to the value of the US dollar. Japan relaxes some of its import restrictions. So essentially they lower tariffs, let's say. So that's going to increase demand for the goods in Japan, right? So in order to buy goods in Japan, you need Japanese yen, right? Exactly. And so then you're going to need to do what with the dollar? You're going to sell the dollar, right? So that's going to increase. So here's our supply, right? I'm sorry, this is demand, this is supply. This is supply. So the supply is going to increase. So what's going to happen to the exchange rate? It's going to go down, right? So the value of the US dollar is going to go down. So we're going to have a depreciation of the US dollar. If Japan relaxes import restrictions, Japanese residents will demand more US goods and more US dollars to buy those goods. The US dollar, it relaxes import restrictions. I'm sorry, I totally screwed it up. Yeah, I screwed it up. Yeah, I thought they were talking about, anyway. So they relaxed import restrictions, so they're going to be buying more goods from the US. Sorry, folks, I'm tired, right? I start teaching at 9 in the morning. Cut me some slack here. Anyway, the US dollar is going to appreciate because, again, import restrictions have been decreased. That means Japanese folks are going to want more of our goods. That means that they're going to need more dollars. That means that the demand of our dollars is going to go up. And so if the demand increases, then that's going to increase the exchange rate. So that's going to be an appreciation. Sorry, I get marked off for that one. Fortunately, there's a curve, so I'm fine because I'll get the other ones right. Anyway, the United States imposes some import tariffs on Japanese goods. So the United States puts taxes on Japanese goods. So what's going to happen to the demand for Japanese goods in the US? It's going to decrease, right? So if the demand for Japanese goods decreases, that means the demand for the yen will decrease as well, right? That means that the supply of US dollars is going to decrease, right? Because we're not going to be selling as many dollars in the US to buy yen, right? I'm sorry, this is supply over here. Supply decreases, so that's going to increase our exchange rate, right? If the United States imposes import restrictions, Americans will buy fewer Japanese goods. Americans will want to exchange fewer dollars for the yen, so the supply of US dollars will decrease and the US dollar will appreciate. Interest rates in the U.S. rise dramatically. So what's going to happen to the value of the U.S. dollar? It's going to increase, right? International investors want high interest rates. They want high interest returns on their investments. So if our interest rates are going up, money's going to be coming in. Capital inflows are going to be positive. So in order to invest in our stuff, they're going to need what? U.S. dollars, right? So the demand for U.S. dollars increases. So just your trusty old demand and supply. Here's your demand. Bam. Moves to the right. What's going to happen to the dollar? It's going to appreciate, right? It's going to appreciate in value. So a dramatic rise in U.S. interest rates will attract Japanese buyers of American assets as well as discourage Americans from buying Japanese assets. This will be an increase in the demand for U.S. dollars and a decrease in the supply of U.S. dollars, and the U.S. dollar will appreciate. A report indicates that Japanese cars last much longer than previously thought, especially compared with American cars. What's that? True or false? All right, so obviously the demand for Japanese cars is going to increase, right? We're going to need more yen. We're going to sell more dollars, right? And the dollar is going to depreciate, right? So a report indicating that Japanese cars last much longer than previously thought, especially when compared with American cars, will increase the demand for Japanese cars and the demand for Japanese yen. The yen will appreciate and the dollar will depreciate. Hey, we're done! Congratulations, everybody. All right, folks. Good job getting here, and now you've got a week's worth of very hard work. I expect you to work extremely hard every single moment. This is not a joke. This is reality. You are going to have 4 to 5 weeks of free time past the last final you have. You are going to have a lot of time to relax and enjoy your lives. This is not the time to relax. This is not the time to enjoy your lives. This is a time to sweat, to cry, to bleed, and to get A's on your finals, okay? So make sure that happens. I wish you the best of luck. Is there a question?